Hi, I'm Chris.
G'day, I'm Joel.
So in this episode of Money in the Tank, we'll first be discussing our books recommendations of what we think are a good place to start learning about investing.
And then we'll jump on to the recent discussion on Bitcoin and the controversial topic of how it works, how it is an investment, is it currency, and how Tesla just purchased $1.5 billion to put on their balance sheets. This is Money in the Tank. Yeah. So Joel Seach, principal advisor of my own financial advisory company, been advising now for about 13 years out of university, in my mid-30s.
Yeah, and I am Chris, also known as Arnie, so feel free to use that term, and a tax professional. I actually work for the ATO, so I want to reiterate that this podcast is for educational purposes, and if it comes to a tax matter, I will not be able to comment on it. I'll have to refer you to the ATO website.
And general in nature, as always. And hopefully you've seen our logo on our podcast. I didn't like how you put Chris there. We might have to get that changed to Arnie. Because for those listeners out there, I didn't actually know Arnie's name was Chris for the first 10 years of knowing him. I actually thought it was Arnie. So one of those mates that you know just by nickname and not by first name for so long.
I love that too. I prefer Arnie.
Yeah, love it. So we might have to chat to our Matt, our producer, on that one. But yeah, that's just an intro on ourselves, I guess, in terms of a bit about us, just to recap on that, and just getting into the podcast itself. And thanks for everyone listening last week. It's been great to have such good feedback, and we'll definitely be keeping the topics easy to listen to. That's really what we're aiming at, more broad personal finance stuff, and for people that can tune in, whether you're at a novice level or an intermediate level, or even some expert level, but really want to cater to people just in our demographic, our age group and above, that wanting to get ahead and wanting something easy to understand, and fill in some blanks for people.
Yeah, we really appreciate the overwhelming response for our first podcast, and we appreciate each and every one of you listening. So going to do our best to give content that is desirable. So let us know if you have anything, and we've already got some good feedback, so keep it coming.
Or sponsor interest as well.
Yeah, we've got, what have we got so far, Jolly? Who's coming through?
Well, Berkshire Hathaway, Warren Buffett's company. Yeah, they're already interested in Tesla, Elon Musk.
Just wait for that 13F filing. They're going to drop shares in Money in the Tank.
just to name a few, yeah. Just to discuss the origin of the name Money in the Tank, since you said it, Arnie. I guess one of the philosophies as an advisor that I like to live by in my life, but also clients' lives, is just generally chatting about the journey of life and the journey of money and where it can take you. So I'm always a big advocate for money not being the destination in life, but money being a means to an end, or money in the tank is effectively filling up your tank with petrol, diesel, gas, or electricity nowadays, with the electric vehicles, and getting you to the destination. So money, I don't think, should ever be the destination, but it's all about filling up the tank in life, the journey that is life, to get you to the destination from point A to B to C.
Can I say, Jolie, that I Googled it after our podcast last week, and there's an Investopedia article that says that money in the tank is like money lost, which I also love that as a dual meaning for our podcast, because Obviously it's the antithesis of what we're trying to achieve. And I also don't mind that it's got a bit of an Australian spin on it, where we love a bit of rhyming slang here, money in the tank, money in the bank. So I think we've hit the nail on the head with that one.
Absolutely.
I know before we jump into our main topic this week, you and I said last week that we were going to discuss briefly some of the books that got us into investing and what we might recommend to people who are just starting out. So do you want to jump into some of your recommendations, or maybe we'll do one or two each?
Yeah.
I'll jump in.
Yeah, so a couple of the ones that I just checked the bookshelf in that, as I mentioned, more audio books nowadays, but checked the bookshelf, and it was funny to see some of the ones that I remember first reading as a teenager. I don't know if you ever remember a guy called Rene Rivkin. He was sort of one of the first kind of celebrity Aussie type share investors that I think he passed away probably in the early 2000s maybe, but had one of his books. He's sitting in a convertible car on a freeway, just laying back with a cigar in his mouth, and it was so hilarious. I remember reading that back in the day, and understanding first understanding or reading about like a PE ratio of a share, and it was pretty cool to sort of read that and actually reminisce on that. When I probably read that, I might have been maybe 17, 18 thereabouts.
Man, the name's familiar. So what? So like you said, it talks about the basic ratios you need for fundamental analysis. Is that what his book does?
Oh, I'd have to reread the summary of the book, but it was more about just telling you about shares and how they work and how to buy in and what a takeover of a company can do to a share price, and how he's made money off shares. And I think he was probably in his mid-50s at the time of writing of the book, and he passed away not old, maybe in his 50s or 60s. But I remember him being one of the early kind of celebrity share guys back in the day. Along with your people like Paul Clearow and whatnot. But that was one of the books, which was pretty cool. Rich Dad Poor Dad was one of my early ones, which we did mention last week. Barefoot Investor, which I agree with some of his stuff and some I don't. Richard Branson was a cool one. The Buffett book. And then some property books as well. One of the good property people I like, Margaret Lomas, was a really good book. I've pretty much read most of her books. So, some good ones out there.
That's one that I'll take note of because I do want to, as I said, I want to read more about property investing. So I'll get that off you afterwards, Margaret Lomas. But you snagged two of my ones. And I don't know if we did mention it last week, but I feel like it's a big cliche at this point because I feel like everyone recommends this as a first book to start with. But it's true because it's so good that Rich Dad Poor Dad is an incredible stepping stone when you need to start thinking about this topic, because it really puts you in a mindset of, okay, I need to buy income producing assets, not assets, or not what Rich Dad Poor Dad would call liabilities. Like, he makes a point in the book that, if you have a bunch of money and you spend it on a fancy car and then you've got no money left over, that's not an income producing asset. That's actually a liability that's just going to cost you more money in the future. Whereas, taking your money and investing it into a business or something that will generate cash flow or passive income for you in the future is where he focuses his money.
Yeah, you're right. And I think it's a mindset thing, that book, over anything. It's quite an easy book to read, but it puts you in a mindset of smart moves over dumb moves throughout life, and how he, learned from I think it was his friend's dad, was it?
His rich dad was actually his friend's dad.
Yeah, that's right.
Started up. Yeah, he ended up employing them. That's why it's a great read, because I think it might even be fictional. It might have come out that it wasn't actually a true story, but nevertheless, the way the story is told between him comparing his home life with his poor dad, who worked hard all of his life and had nothing, compared to his friend's dad, who he calls his rich dad, who basically employed them and taught them how to become entrepreneurs.
And because of that book, I've actually never bought a new car. I think it's because of that book. I've always remembered the depreciation of the car. I've never bought a new one. The most recent one I bought is 3 years old, but under warranty and whatnot. But I think 2 years, 3 years is probably the most I've ever bought in terms of a car demo or whatnot. I've never bought a new car, and it's because of that book being ingrained in me, which is funny. What books do to you?
Yeah, it's excellent. And the other book I was going to mention, which you also touched on, I'm going to talk about two more. One, I think Barefoot Investor, and I wholeheartedly echo your sentiment that there's some things that he talks about that I agree with, and some things that I don't agree with. But his book, I think it might just be called The Barefoot Investor. I don't know if it's actually got a title other than that. I know he's got another one that came out subsequently, which is called Barefoot Families, which I have not read. But I think that one was instrumental for me in one particular aspect of personal finance, and that is budgeting, because I hate budgeting. And once I read his book, he delves into this bucket theory, almost like a reverse budget, where you just allocate, you got 100% of your paycheck or however you earn money that comes in, and then you allocate it into buckets. And he advocates for, and I might be getting this wrong, but I think it's like 60% into his daily expenses account, 10% splurge, 10% goals, or I think he calls goals smiles, and 20% fire extinguisher. So basically, the fire extinguisher is money that you throw at the big things that life throws at you, like capital repairs or car repair or something like that. And then if you've got any money left over, you invest that money. The goals or the smiles is for holidays and meals. The splurge is for whatever you want, and daily expenses covers all of your daily expenses like food, utilities, etc. And I don't know if it necessarily replaces a budget. I feel like you still need to do a budget at some point. But that was just an easy way to get it going, where you can do a simple allocation. You know what I mean?
Yeah, absolutely. Yeah, proactive way of thinking rather than retrospectively budgeting. I think proactive, and I use it in advice for clients all the time, is proactive separation of cash flow and allocation so that you're always feeling empowered with making decisions, making moves, and putting money towards certain goals and items. And I think that's a way better way of doing things than retrospectively looking back and ticking things off in the past month, because that's in the past, and everyone's working towards the future and working on the next thing they want to get to.
Yeah, and the last book I want to recommend ties into that idea. And I don't know if this is where Scott Pack got the idea, but I think it's not necessarily an original idea. I think it's been around for a while. But the book I want to recommend is called The Richest Man in Babylon. And it's a really old book. I believe it was actually written, or maybe it was contracted by banks back in like the early 1900s. And the whole point of The Richest Man in Babylon was to pay yourself first. Well, actually, there's more points to that book, but in general, that's the first lesson. And it basically means before you do anything else with your money, you need to set some money aside. And the goal of that money that you set aside, and I think they advocate for 10% in that book, is to accumulate enough money to then have the opportunity to make a sound investment and have your investment work for you and return more money. Which I feel like is just, it sounds simple and basic, but a lot of people, myself included in the past, didn't do that. Now, when I get my paycheck, I allocate off my money I want to invest before I do anything else with the rest of the money.
Yeah, absolutely. And I do remember reading that book as well on a plane, I think. I don't think it's, from memory, a really big book. Very easy to read. And it made sense. And I think, if you got the willpower to be able to do that, that's great. And it's all about having accountability, I think, whether you've got someone keeping you accountable, if you're in a couple, keeping each other accountable. Some people struggle with that, need advisors or counsel to help, keep them accountable to their money and making sure they're going in the right direction with it. I think that's really the most important thing, is you're achieving things that you want to achieve out of life. And I'd add to that, putting it away for a rainy day, or putting it away for the long term, but also always having an eye on the short term, the medium term, as to what's coming up, what you want to try to do in life, whether it be a goal that you're setting for each other to travel or do, or learn a new skill, and then you got the long term, which is retirement, because retirement is such a far way out, especially for people 20s, 30s, and 40s. It is a long way out. So retirement sort of has this long-term connotation as such. I think short-term stuff is also really important when you're setting goals, because it keeps you on track. I think keeps you on a path to achieving something that's tangible and not so far out.
Yeah, that's right, man. I think, and also you don't want to be a miser either. You got to enjoy life on the way. So,
absolutely
set aside a little bit, but still enjoy the good things. So
spot on.
But that's a good wrap up of our recommendations for what you might want to start reading if you haven't read anything, and maybe we can delve into some other ones in future weeks. But should we jump into our main topic today, which I'll let you announce if you want?
Yeah, sure. So I think, one of the cool topics and the cool thing about this podcast is we're going to be diverse in nature in what we want to cover. So it could be anything, that comes up during the week, or anything that someone asks a question over that we can discuss and broaden out on and really sort of, hone in on a little bit as well. So it could be property, it could be cash flow, it could be investing, could be shares, whatever it may be. So this week Bitcoin came in the news again. From Elon Musk, who is the CEO and founder of Tesla, came out in the records of his company's minutes, I believe, that they purchased about 1.5 billion of Bitcoin.
Yeah, 1.5 billion USD.
Yeah.
And it has sent it skyrocketing. As of recording this podcast, all-time highs, $47,521.50. That's US dollars.
Yeah. So full disclosure, I don't own any Bitcoin at the moment in my portfolio. I may in the future, I may not, still don't know. But I think the important thing is the cool thing is to be able to chat about something like this. So, what is Bitcoin for people that aren't aware? And Bitcoin, I guess you could be classified as a peer-to-peer lending. So when you talk about, if I need to send Arnie money and he's overseas, for example, wherever it may be, it's got to go through a third party, so an institution. Bitcoin in a way or crypto in a way, is a decentralized way of transferring money instantaneously. So it's cutting out the middleman, and it's cutting out governments as well. So it's a really interesting type of money or investment, whatever you want to call it. It started back, I believe, in 08, 09. and it's
Yeah, there was a white paper dropped by Satoshi Nakamoto. Is that his name?
Yeah, they still don't know if it's a him, a group, an alias. But yeah, Satoshi Nakamoto, I believe, is that no one really knows him. I think the last communication was in 2010. That again brings to the what is Bitcoin? It's sort of mysterious in a way because you don't even know who founded it or who started it. You just sort of, it's a bit of hearsay, and whether we hear from him or them in the future or whether we don't, it just sort of again leads back to there's no one person that's making decisions on Bitcoin. It's not governed by any government or group of governments. It's purely run by blockchain or coding and technology.
Yeah, well, you hit the nail on the head. That's what it was intended to be when it was created by Satoshi Nakamoto, which you're right, is an alias. So I'm just going to refer to Satoshi Nakamoto as him, but if I do, it doesn't necessarily mean I think it's a man. It could be a group of people or a female. It could be anyone. So, yeah, you're right, Jolly. That's the white paper. I had a quick glance at it when we were researching this topic because I've been the biggest crypto skeptic for a long time, and having a read of it just to research for this made me reconsider that position. I don't know if I would go so far as to buy Bitcoin or any other cryptocurrency yet, but it has piqued my interest and I want to do a bit more reading. But I think, the form of payment, Bitcoin as a form of payment, from what I'm reading, is basically taken a back seat in recent times because of the volatility in Bitcoin's price. And now it's viewed more as primarily as a digital asset. And it's sort of similar to gold, like a precious metal. People are seeing it as a store of value, mainly because one of its features, I guess, is that scarcity, and that gives it value.
Yeah, completely agree, Dog. And I think, some of the summaries that I've read about was, it's scarcity as such with gold because, gold's been around for so long now. And I believe gold, they managed to mine 1% to 2% of extra gold every year, which I guess gold's value again is an interesting one in itself because it's not gold doesn't do anything. It's just pretty and can make nice jewelry and crowns, and people put the value on gold themselves. Us as a people say, okay, well, gold's worth more than silver, and it could be a scarcity thing. It could be just what we feel is the perceived value of it. So Bitcoin, in a way, is like gold. It can be shaved off into small Bitcoin amounts to be purchased. I guess gold can be the same in that regard, but it's scarcity in terms of we know the amount. It's 21 million Bitcoins that will ever be able to be mined. That's sort of the interesting comparison there.
So can I just take a step back there, Jolie, just in the interest of explaining it out for everyone and maybe just setting it out for myself. So we talked about two important concepts there. Comparing Bitcoin in particular and gold, because it's scarce, and we're talking about it in these terms as a hedge against inflation. And that's what gold has been traditionally, because you're right, it has minimal value as jewelry, or it can be used in certain things like computer circuit boards and stuff. But really what gold's been over the years is a store of wealth. People have held gold because if the value of their currency goes down in somewhere like Venezuela, where hyperinflation has killed the value of currency, then holding gold, or now something like crypto, a digital asset, is a hedge against inflation. You can store your wealth and no one can get at it, basically. So that was the point of it, right?
Yeah, that's right. Again, back to the decentralized, where governments don't interfere or meddle. At the push of a button, a government can print money or improve stimulus into an economy. So when we talk about the easing, monetary easing, or the printing of money in the US, for example, with a quantitative easing that they've done, that's introducing money. So you've got more dollar bills into an economy, which then devalues that dollar bill. For example, if I've sent you that $100, Arnie, that $100 can then be worth a bit less because there's more of it in circulation, and it means that if there's more money in circulation, it means that money purchasing power can't buy what it bought just the other day.
Yeah, that's exactly right. And I think the comparison to gold is an interesting one as well, because you were touching on this before, but the fact that it's decentralized, the fact that Bitcoin is not controlled by any one country or body, means that it can't be confiscated. And in theory, I guess you could try and hide your gold, but there's been times in the past, I believe, where governments have called on people to like give their gold back. I think in the Depression, I need to fact check this, but in the Great Depression that occurred, people needed to come in and like give their gold back to their government.
We don't fact check here, mate. We don't fact check. And cryptography is the process of mining, and it can't, supposedly cryptography, crypto, it can't be, the Bitcoin server and the coding can't be hacked. I think what's been hacked previously is the storage of it, so where you've been storing it, but the actual blockchain or the Bitcoin itself hasn't been hacked as such. So it's a store of wealth. People can buy a Bitcoin, and if they feel like that Bitcoin over the next 10, 20 years is going to be worth a heap more, then they hold on to it, and you take one out of the market, and then you've got 21 million or so of those floating around, and the more people buy it, the more it becomes, as we were saying before, a consensus of something being valuable, valued.
Yeah.
So if we put a price on a random metal like copper, for example, if there was a consensus over the past 1,000 years that copper was worth more than gold, then it's what people's perception of worth is on something. So you're starting to get companies now buying it, which I guess which is a cool introduction to this topic of creating consensus around something's perceived value in the world.
See, I struggle with that concept, and it's partly what's made me a crypto skeptic over the years, is that I feel like crypto is a zero-sum game because, for Bitcoin to go up, or any crypto, maybe not any crypto, I haven't researched all of them, but for Bitcoin specifically to go up, it means that someone has to be willing to pay the higher price to buy crypto. And it basically means you're robbing Peter to pay Paul, because there's no intrinsic value to Bitcoin. Yeah, it's being used as a store of value, but you can still argue that gold has intrinsic value. And then the argument becomes, yeah, but gold's not worth as much as this intrinsic value. People pay for it because they want to wear nice jewelry, the same way that people pay enormous amounts of money for artwork. Artwork is just canvas and paint. Is it worth $50 million for a Van Gogh? And you might argue yes, you might argue no, but I would also say that whoever's paying $50 million for a Van Gogh doesn't need that $50 million. They're not thinking, I'm going to buy this painting, and if I need the money, I'll sell it. Whereas Bitcoin, a lot of the arguments people are saying, it's a store of wealth akin to gold and paintings, and I just feel like they're a bit different. I feel like gold and paintings above their intrinsic value gives status, and Bitcoin, I don't know if it does or if it can, but at the moment, I don't think it does.
Yeah, it's an interesting point you raise, and I think over time, only time will tell, and over time, it'll be interesting to see that perception of, what it is and what Bitcoin's feeling is amongst the community of just people and investors in general. So whether Bitcoin does have a sense of, anarchy, or not anarchy, but people going against the grain and fighting against the governments and not using their third-party transactors and wanting to keep it digital and keep it off their hands. So it's an interesting one, and is it, speaking of artwork, is it the Banksy of the art world? Is crypto sort of the Banksy of the investment world? It's a really interesting one, but I think, as people are starting to use it and companies are starting to use it, so a few of the companies I've written down is Square, PayPal are going to be beginning to accept it. I think another in Fundy, Fidelity, and Tesla, which is the one that came into the news. Tesla, in its minutes, bought using its cash. I think they felt like a few of the other companies that could better utilize their cash rather than holding the US dollar, which is being potentially devalued by that printing that we spoke about. They're essentially using their cash money and purchasing 1.5 billion in Bitcoin. And in the lining in the minutes, they also said that they'd be willing to potentially start accepting Bitcoin to purchase of Tesla vehicles, and which they may or may not hold on their books or sell. So it just, again, it sort of, Musk is putting his money where his mouth is to an extent by saying we're going to use 1.5 billion of our cash money to buy Bitcoin and put on the balance sheets. And what was, earning 0.25 probably of a percent of interest, or maybe a percent of interest at the most, is now invested essentially. And that's the other interesting thing that we could speak about or talk to, it is an investment at the moment, and it's trying to play currency. But again, I'm not for or against. We're just fleshing it out here. But it's so volatile at the moment. It's hard to see it being a currency, but that could also, as more and more people accept it, then that volatility may start to die down a bit and start to fluctuate less. It could be then, a form of currency in the future. But at the moment, it almost seems more like an investment.
See, I wonder about that, Joel, and I'll delve into why. And I did a bit of research on this because I think you've hit the nail on the head. I feel like, yeah, they're saying they're going to accept Bitcoin for Teslas. And I might also add that MasterCard said they were going to accept some crypto on their network. So you won't have to go between like USD to crypto and vice versa. You can just trade crypto. But they were careful to say that they were going to focus on stable coins. And I think the most famous stablecoin is Tether, which is tied to the US dollar. So one Tether is worth $1, one Tether token, I should say. So if accepting Bitcoin as payment, I feel like that ship has sailed, and it's so volatile because after each, they've got these events in Bitcoin called halving, and I need to do more research about this. But from my understanding, what it means is that every 4 years or so, there's a halving event. And that means that, every time one of these blocks is uncovered on the network, the people who are able to solve the complex mathematical formula through their computing power get awarded Bitcoin. And I think currently it's 12.5 Bitcoin, or maybe it was 12.5 Bitcoin. And I think it was 12.5 Bitcoin. And in 2020 it halved, and now you get like 6.5 or something like that. So 6.5 Bitcoin, every 10 minutes, one of these things is solved. Obviously, that's going to be incentive for people to mine Bitcoin. But then what happens after these halving events, which is a similar thing to what happened in 2016 was the halving before that. And in 2017, you had a bull run. 2020 was the next halving. And now you've had this huge bull run, and it's gone up to, what do we say, $61,000 Australian or 47,000 US.
Yep.
And then historically, after each halving, about a year after the bull run, Bitcoin crashes and loses 80% of its value. So if Tesla's going to start accepting payment for cars in Bitcoin, how are they going to track that? Like, they're going to have like an exchange constantly monitoring like how much Bitcoin is worth to a US dollar. And then if people know that this is happening and they know that, 80% of the value is going to go, and then they can buy in and wait a couple of years for the next halving event, which will be 2024, and potentially make 10 times their money. Who's going to want to spend Bitcoin on a car?
Yeah, that's
you'd want to hold it at that point.
Yeah, that's what I've always thought with currency. When you're talking about it as currency, you buy a boat or you buy a car because they're accepting Bitcoin, but you're wanting to get rid of your Bitcoin, and if you're paying for something, if you're paying for goods and services like a car, let's say a Tesla costs, cost the company $70,000 US to make, or I'm just picking out a figure, $50,000 US to make, and they're needing to generate the profit they want to make. They're needing to sell that car at $135,000 US. If they're accepting that in Bitcoin, and they're accepting, let's say, 3 Bitcoins, so 47,000. Let's say that the car's worth 150 or just under. And then they accept that Bitcoin, but then it goes down in value significantly. Where does that predicament? They obviously need to have a lot of cash set aside to be able to cover that, so they don't need to sell that Bitcoin. Would be my guess. Is they're putting money in, and Tesla no doubt has a lot of cash, but putting that Bitcoin aside as a store of wealth, and then I guess waiting for it to come back up again, or they're banking on that. It'll become less volatile over time as more and more big companies like them begin utilizing it and accepting it as a form of money, of trade.
Yeah, I just think that by the time that occurs, you're going to have competitors that wipe it out. Like, I think Facebook talked about their cryptocurrency, Libra, which they're going to have as part of their platform. Amazon might do something similar to try and compete. And then you've got all the other competition that already exists. Like, I think you've got, what are some of the big ones? Ethereum, Ripple, Litecoin, Cardano. So you've got all these ones coming in the background, which are challenging. And I think it kind of touches on why Bitcoin has got to the number one spot, is because I think previously, to trade in these other coins, altcoins, some people call them shit coins, you've had to trade with Bitcoin. So basically the liquidity was in Bitcoin because you needed it to trade in these other coins. Whereas now that's not the case for all of these coins. And That's evident by things like Square and PayPal, accepting crypto, and now MasterCard, that you're going to be able to just use fiat currencies to buy them. So I don't know if Bitcoin will have that number one spot forever, because it used to have it because of the liquidity raging through it. So it's an interesting landscape. And when I think 10 years out, I think, do I want to own Bitcoin, or do I want Bitcoin in my portfolio? I think I'm too risk averse to get something like Bitcoin.
Yeah, well, only time will tell. And I think some of the podcasts I've listened to on it, or just generally reading on it, and as an advisor, we always talk diversification. So it might be someone holds 1, 2, 3, 4, 5% of their portfolio in Bitcoin as a diversifier that, it could be, have potential to be a good non-correlated asset. So, if, non-correlated, we're meaning if shares go up, for example, then Bitcoin might drop off. And you can then use some of your share money that's gone up to buy a bit more Bitcoin, and vice versa. For example, when we talk about a non-correlated asset, it's always good because it moves in a different direction to something. So if your Bitcoin goes up, you'd hope your Aussie shares, for example, or US shares go down a little bit, and you can take some Bitcoin, slice a bit off, sell a bit off, and buy some more shares just to buy in a bit lower with the shares again. So you've got the potential as an alternative asset, but whether it'd be a great asset to hold a huge amount of, it's very, very skeptical. But again, general in nature when we're talking about these things, and it's always good to have an open discussion about it. And if anyone has any thoughts on it being an alternative asset or an investment or currency, I'd love to hear from you. But just a cool topic to talk about, and I think in general terms, just to flesh out and explain a bit more about it and what it is for people that may not know, or people that want to know a little bit more on it.
I love the idea behind it, and if I'm flipping my hats on and off here, going between bull or bear thesis on Bitcoin in particular, I know that one of the original the original bull thesis on Bitcoin was that because monetary policy is basically just, well, in some countries it's seen as farcical, that they use their monetary policy just to juice their markets, just to keep growing asset prices, and it doesn't actually help the economy. It's just the rich get richer, and then they write studies saying, because the economy is going up, then a rising tide lifts all boats, and this rich billionaire is creating more jobs, which is employing more people. So people are getting sick of that, and they're saying, well, you can't just keep juicing the market hand over fist, because eventually something's going to break. And when it does break, we're going to have all our money in crypto, which can't be touched because it's decentralized and no one controls it. And that sort of leads me to a point you were discussing before, and I meant to jump in and talk about it, so I might talk about it now, is the security of Bitcoin. You were mentioning that it's like unhackable, Jolie, and I was doing some research on that, and it's not that it's unhackable, it's just that if you hack the Bitcoin network, it basically devalues Bitcoin. So why would anyone want to hack something and then devalue the very thing that they've hacked?
Yeah,
so
that's right. I've heard this, sorry to cut you off, but I've heard them saying you're better off spending that energy and time into mining more Bitcoin.
That's right. It incentivizes people to join rather than try and rip it off, because there's this concept that's called, I think it's called a 51% attack. And it basically means that to overwhelm the Bitcoin network, to try and get any Bitcoin out of it, you need to have computational power equal to greater than half of the computational power that already exists and is growing, because people are jumping in. Like you and me can get a rig and start trying to mine Bitcoin. We're probably not going to have much success versus, the warehouses of data centers that are already doing it. But we can jump in and we can participate, and we might get some Bitcoin. So for people to overwhelm the network, they need 51% of the power to do it, which is going to cost billions and billions and billions of dollars to do so. And then when you do it, you undermine the security of the network and devalue Bitcoin to nothing. So what you've just stolen now becomes worthless, not just for you, but for everyone.
Yeah, it's an interesting one, isn't it? Yeah, and they talk about the hacking, and I think the stories you hear of people breaking into wallets or breaking in to get code and steal Bitcoin. But I think Bitcoin is trackable. Every Bitcoin owner is trackable to where it was owned and by the code and whatnot. So
that's where people can lose it. If someone gets your Bitcoin key, which is what you store in your wallet, which could be on a hard drive, or it could be on like a cloud service.
I think it's like a 30-digit code or something. It's like letters and numbers, I believe.
Yeah, if you lose that, you basically lost your Bitcoin.
Yeah.
Once someone's got that, they can transfer it to themselves and just move it on. And there's no because it's not controlled by anyone and it's decentralized. There's no one you can complain to.
Exactly. So you've got to remember that code. You've got to write it down somewhere. You're not going to lose it. That might be another cool podcast we could do one day. Is talk about some funny or heartbreaking stories of people losing their code or losing their Bitcoin. There's some horror stories out. There's some real.
I forget the guy's name, but like earlier this year, when it had that huge run, maybe late last year, some guy was saying that he threw a hard drive out that had like 7,500 Bitcoin keys on it.
Yeah,
and he couldn't. I don't know how much that's worth now, but goddamn, that poor bastard.
Yeah, some horror stories. That might be a funny one to bring up, but I think there might be a couple of million of Bitcoin that are lost out there, I believe. But anyway, never to be.
Well, they say Satoshi Nakamoto, the person or the group, holds almost 1 million Bitcoin. And they said that their Bitcoin on the blockchain hasn't been touched since 2010. So people are expounding, saying that person or that group, like if it is one person, might have passed away. And then what do? Like you can't get those 1 million Bitcoin back. If it's only ever going to be 21 million Bitcoin, which I think they won't mine the total amount of Bitcoin for another 120 years. But you're right. Like if you've lost 1 million Bitcoin, and let's just say you've lost some more Bitcoin, like this guy with his hard drive, let's just say total you've lost 4 million Bitcoin out of the possible 21 million that will ever exist, then you're basically reducing the supply again, and that's just going to pump up the demand. But then at some point, you're going to have to extrapolate out that you're going to lose every single Bitcoin.
Supply demand. Yeah, really interesting. But yeah, I think it's a fun topic, man. It's there's so many little ways you could go with it. And it's really interesting. But yeah, mate.
I would love to hear from people, and I'd love to hear from you. Maybe we could talk about this now, but I want to hear from people like, do you like Bitcoin? Do you not like Bitcoin? Do you like crypto? Is there a better one that Joel and I should have a read about that's better than Bitcoin?
Yeah.
Yeah,
every episode's not going to be on crypto, but this is a cool one. I think whenever there's something in the headline that's big like this that happens, and there's probably going to be another few big companies over the next year or two that potentially get into using their cash into crypto because they feel like their cash is not doing enough for them. So really, really interesting, and we're at record low interest rates. So we'll only time will tell. Will be cool to hear.
One more final point from me on not just Bitcoin, but all crypto, which I think has enormous potential, is that the fact that it's programmable, like it's smart money. And I don't know what the full implications of that might be, but there could be some exciting things there that Bitcoin or cryptocurrencies could do. I'm interested in that space, so I'll do more research there.
Cool, man. Awesome. Well, to finish off on, we wanted to hone in on an area of fun that we tend to always chat about anyway, is just our disagreements on certain things that we have to keep it lighthearted at the end of a finance or personal finance podcast, because investment is all about choices and what you prefer over what you don't prefer. So do I prefer to buy a Bitcoin, or do I prefer to buy some shares in an Australian company, for example, or some shares in McDonald's. So it's all about choices, and you and I, we want to run a little gimmick at the end of this podcast called Either or we could think of a better name, but we only really sort of spoke about it briefly. Is just choosing between one thing or another and have a different topic each week, and hopefully we disagree more than we agree, because it'll make for much more entertaining topics.
I think we probably will disagree on most things, just well, maybe not. We do have a lot in common, but go on. Have you got one for this week that you thought about?
So the first one this week we wanted to do is the age-old question of chocolate in the fridge over chocolate in the pantry, and what the preference is. So I told you the topic, but I haven't told you my answer yet. So I'd love to hear from you first, and even your preference and Kate's preference, which is your lovely wife, and then my preference and Erin's. So please, you start us off, and then I'll come in.
All right, I will. I prefer chocolate outside of the fridge, unless it's really hot weather. So I know I'm kind of sitting on the fence there, but majority of the time I like it out of the fridge, and Kate's the same. So
you mean you mean out of the fridge? You mean in the pantry? So taking it room temperature chocolate.
Room temperature. That's right. That's right. I don't want my chocolate like ultra cold or hard. I feel like the joy in it is that it's like melty. I'm curious now, like what yours is.
Yeah, I'm out of the fridge. Yeah, in the fridge. I prefer to eat it out of the fridge. So having it stored in a cool environment. I feel is the way to go with chocolate. Having it, whether it be a hot or a cold day, I feel like chocolate tastes better just inside the fridge there, cool. Once you get into it, it's ready to go. The only thing I don't like in the fridge is like caramel M&Ms. I think I've tried; they're no good in there. Summer rolls or honey logs, they're no good in there. They're a bit too hard. The nougat, but everything. That's we're sort of really drilling into chocolates here, but. More broadly, I find chocolate way better in the fridge. So I
can't believe that. I'm astounded. I thought you were going to be a pantry man for sure.
Completely disagree with you, mate. I think you need to get your head checked. And for those people out there, I'd love to see a percentage split on that one when we release this podcast, as what people prefer to have chocolate in the fridge over in the pantry. I have heard of a few sickos out there that keep lollies in the fridge. I don't know, debatable.
What?
Yeah, lollies in the fridge. Yeah, I've heard of it. Like Alan's like snakes, in the fridge. So,
that's the worst.
Yeah. I have tried some chocolate lollies mixed and put them in the fridge, and it's actually not that bad. But there's a few friends of mine that have told me they keep lollies in the fridge, which I've found just too weird.
Well, I won't roast you too hard over the old chocky in the fridge, because I feel like eating and food preferences, are a very individual thing, But if you told me you like something like Terminator 2 over Terminator 1, I just wouldn't be able to handle that.
That will be a topic over the coming few weeks. I think we're going to have to.
Can I ask you one more either or?
Yeah.
And knowing that we've both disclosed that we don't own Bitcoin, if you had to choose right now after us discussing on this podcast, would you buy $1,000 worth of Bitcoin or $1,000 worth of gold?
Oh, that's a tough one. Generally in nature, as always, I'm going to have to sit on the fence and say diversify between the two of them if I only had two choices, which means that my fall
you can't split it. You have to choose one.
My fall down wouldn't be too far, and my increase wouldn't be as much. But
mate, the game.
I'll play the game. I'll just say for the game, I'll say Bitcoin. I'll buy the Bitcoin, and I'll risk it. It's effectively gambling, but I'll risk it.
We disagree again. I feel like Bitcoin's had its bull run, and I'm going to buy $1,000 worth of gold.
All right, cool. Well, let's track it over the next year and see how it goes. So there's going to be either a sharp fall from me, or I'm going to be holidaying in the Caribbean, and you're going to be sitting there in your gold. Anyway,
now, I'm going to extrapolate it, mate. Once the 80% crash of Bitcoin comes, I'll put that 1,000 of gold or whatever it's turned into, and I'll buy the Bitcoin then.
You can't do that, mate. It's only for now. You can only choose it. You got to hold it. All right,
I like it.
Cool, mate. Well, great chatting as always, and looking forward to hearing any feedback from anyone today and any topics of discussion or any questions you may have. Feel free to fire out on any of their social media channels. Until next week, we'll look forward to seeing you guys then.
Cheers, mate. Bye.
Cheers, Arnie. Bye. This is Money in the Tank.